If you're like me, then the idea of having passive income is extremely attractive. That is one of the many reasons that I love dividend investing. Dividend investing allows you to make an investment one time and get paid for it for the rest of your life. In this video, we're going to be going over 3 basic but very important steps to building a successful dividend portfolio in 2023. There's a lot to cover, so let's go ahead and jump into it. The first thing we need to do is to understand how to properly analyze a stock. To do this, we're going to be jumping over to Yahoo Finance, and if we come up here, for example, let's go ahead and say we want to look at Lowe's. We'll plug in the stock ticker and click on this right here, and you can see we have some basic data about Lowe's right here, and we need to go over exactly which of these is important and what do they mean. The first thing we obviously need to know is this number right here showing 200.37. That is the price per share, meaning for each share of Lowe's that you purchase, that is how much you will need to put into your investment. Now, the next thing we're going to come down here and look at is our 52-week range. If you're not familiar with this is the lowest price it's traded at over the past year and the highest price it's traded at over the past year. So when we look at this, we can see that the current price is closer to that lower end of the 52-week range. The next thing we want to look at is the beta of a stock. A beta is essentially the measurement of the volatility of a stock, and a measurement of 1.00 essentially means that the volatility levels of a stock is going to follow pretty closely to the market. If you have a beta of above 1, then it's going to be more volatile, and a beta of below 1, then it's going to be less volatile. Now, the next thing we do want to look at is our PE ratio, which stands for our price to earnings ratio. We can see for Lowe's that is sitting at 19.35. The price to earnings ratio is the ratio for valuing a company that measures its current share price relative to its earnings per share. This is important because this can be used to compare companies that are similar in structure, and we'll be talking about that just a little bit later in the video. Now, the next number that we have is our EPS, which stands for earnings per share. Earnings per share is a company's net profit divided by the number of common shares it has outstanding. EPS indicates how much money a company makes for each share of its stock. So that's definitely a very important metric that you do want to understand. Now, the next thing we can see right here is our earnings date. This is very basic. Essentially, our earnings date is just going to be the date that the company is going to reveal its latest quarterly earnings report. Now, the forward dividend and yield, this is obviously very important if you want to build a dividend portfolio. The forward dividend is how much they're going to be paying out over the next year in dividends according to their most recent quarterly dividend payment. So for Lowe's, we can see that's $4.20, meaning if I bought one share of this stock at $200.44, I could expect to receive $4.20 in dividend income over the next year. Now, the next thing it's showing is the yield. The dividend yield is essentially going to be this $4.20 divided by this $259. And the dividend yield is a good way to project how much dividend income you will receive based on how much you invest. So let's say, for example, I only invest $100 into Lowe's with a 2.09% dividend yield. I can expect to receive about $2.09. So that's a pretty good way to look at it. Now I need to know what the ex-dividend date is. Investors who purchase shares any day before the ex-dividend date will be documented as owners of the share on the record date. That means they'll be entitled to receive the dividend payment. Investors who purchase shares on or after the ex-dividend date won't be recognized as shareholders on the record date, which means they won't be paid dividends. So you do need to purchase the stock before this date if you want to receive the next dividend date. So those are the basics of Yahoo Finance on this homepage, but there is one more really important metric that you do need to look at when analyzing dividend stocks, and that is the payout ratio. If we come over here to statistics, I believe we can find this on Yahoo Finance. So let's go ahead and scroll down, and you can see right here we have the payout ratio for Lowe's. This is one of the most important metrics you can look at for any dividend stock, and essentially it's going to show the percentage of a company's earnings paid out as dividends to shareholders. So what exactly does that mean? It's going to show this is the amount of their earnings that was paid out in dividends. So we can see for Lowe's, it was around 35.71%. So that is a very healthy payout ratio. And this allows it to do a few different things. It means they're going to be able to continue to increase the amount they pay out in dividends over time. And they also have plenty of money to continue to grow the business internally. Let's look at a different example of a payout ratio. Let's say we want to look at VFC. I'll come over here and click, and if we scroll down, we can see they have a really nice starting dividend yield of 7.78%. That's a pretty high starting dividend yield. But let's go ahead and jump back over to our statistics tab. If we scroll down right here, we can see that the payout ratio for this company is sitting at 185 0.19%. Now that is a huge red flag whenever you see a payout ratio that high for a company, because it means a couple of different things. Obviously, it's going to mean that the current dividend payout is not sustainable. So despite the fact that the company currently has a really nice starting dividend yield, it's not sustainable and the company won't be able to pay out that high of a dividend for the foreseeable future. And it also means that the company doesn't have enough money to continue to reinvest back into its business to grow its future earnings. So that's the basics of Yahoo Finance. I think every person who wants to build a dividend portfolio in 2023 needs to understand these metrics. Let's go ahead and look at the next important metric that we need to start looking at if we want to build a successful dividend portfolio in 2023. The next concept that we need to understand is the idea of diversification. Diversification is an important aspect of investing because it helps to spread risk and reduce the impact of any negative events within an investment portfolio. This means that if one of your investments performs poorly, it is less likely to have a significant impact on your overall portfolio because you have other investments that may be performing well. In addition, diversification can help to smooth out the ups and downs of the market and provide a more stable return over time. By diversifying, you can potentially reduce the volatility of your portfolio and increase the likelihood of achieving your long-term financial goals. To show an example of this, let's go ahead and jump into my do-it-yourself investor toolkit spreadsheet. And you can see there's a whole lot of different metrics that I'm tracking right here, but in this video, we're just going to be focusing on the diversification elements. If you'd like to see more on this spreadsheet, then you can watch my monthly portfolio update videos. So this chart here is going to show us each of my positions as a percent of the capital in my portfolio. So for example, we can see Domino's Pizza takes up 3.6% of my portfolio, INTC takes up 1%, and Starbucks takes up 1.6% of my dividend portfolio. So personally, the goal is typically to keep these positions between 1 and 4%. And you can see for the most part, that is the case for most of my positions. Now, one potential risk within my portfolio is you can see Microsoft takes up about 15.7% of my overall dividend portfolio. So in 2023, I think one of my focuses should be increasing the allocation into these other positions so that Microsoft doesn't take up such a large portion of my dividend portfolio. Now, if we scroll down, we can see another chart right here, and that's going to be my stock allocation by industry. You may believe that if you invest into Amazon, Tesla, Apple, and Microsoft, you may be starting to diversify your portfolio, but you have to understand that all of those positions are within the same industry, meaning you really haven't diversified that much. So while it is important to diversify by each individual stock, you also have to do it within industry. So for example, you can see consumer cyclicals take up about 10% of my portfolio. Looks like industrials 3%, communication services 3.4%, consumer defensive 12%, and then I have two large positions in technology and financial. So something that I do need to take note of is that both of these positions take up large positions in my portfolio, so I may want to consider making moves in these areas as well. Now, the last thing we do need to understand about diversification as dividend investors is where is our dividend income coming from? So we're going to be looking at my dividend income by industry chart right here. So again, it's a similar concept. We can see 12% of my dividend portfolio. The income I get from my dividend portfolio comes from technology, consumer cyclical about 6.4%, real estate about 13%, and one potential risk in my dividend portfolio is that financials take up almost 35% of all my dividend income. So if you are a dividend investor, you don't want all of your dividend income to be coming from one place. I have about 35% in financials, so again, in 2023, I should probably focus a little bit more on these other sectors here. The last step we need to take in order to build a successful dividend portfolio in 2023 is learning how to properly value a stock. Learning how to value stocks is an important skill for investors because it allows them to make informed decisions about which stocks to buy and to sell. By understanding the fundamental value of a stock, an investor can determine whether the stock is overvalued or undervalued in the market. Now, there are multiple different ways to value a stock, such as Graham's valuation, a discounted cash flow, a multiples valuation, and the dividend discount model. And while learning to value stocks can be quite a process, I've made the process extremely easy by building out templates within a spreadsheet that makes it much easier to value a stock. And in this scenario, let's just look at one valuation, the multiples valuation. This is one of the more simple valuation models, yet it can be very effective. Essentially, what it's going to do is we're going to be taking the company that we're currently trying to value, which is Lowe's, as we can see right here, and we're going to be seeing how its competitors are trading relative to Lowe's using a price to earnings multiple. So if you'll remember, if we jump back over to Yahoo Finance, earlier we talked about the PE ratio and the earnings per share. Both of those are going to be very important in this valuation model. But essentially, with this tool that I've created, all we have to do is we plug in some competitors of Lowe's right here, like Home Depot, FND, we can plug that in, and we'll say LESL. We have three competitors here for Home Depot now. We have their stock price, we have their earnings per share listed, and we have, most importantly, their price to earnings multiple. Now, essentially what we're going to do with this is we're going to take the average price to earnings multiple, we're going to multiply it by Lowe's earnings per share, and once we've done that, congratulations, you've just performed your first intrinsic value calculation. We can see according to this valuation model, Lowe's is currently worth about $195.20 per share. Now, when you compare that to the current trading price, you can see it is very close at $200.56 per share. So there you go. Those are three ways that you can build a successful dividend portfolio in 2023. These are steps that I use daily in my investing journey. In addition to this, the spreadsheets you saw in this video are tools that I use every single day to help me be the most successful dividend investor that I can be. You can download them at the link in the description. Seeking Alpha is also a tool that I use for dividend stock research. Depending on when you're watching this video, you can get up to 83% off Seeking Alpha at the link in the description. So that being said, thank you guys so much for watching this, and please don't forget to like and subscribe to the channel.